Is the stock market really a fair game, or is it rigged against everyday investors? While Wall Street insiders seem to always come out on top, regular traders often struggle to keep up. Is it just luck, or is there something deeper at play? In this video, we'll uncover the shocking truth about how the market really works, who's pulling the strings, and what you can do to protect your investments. Whether you're new to investing or a seasoned trader, you won't want to miss this eye-opening breakdown. Stay tuned. Today, we will talk about, is the stock market rigged? The shocking truth you need to know. So before we get started, make sure to hit that like button, also subscribe to my channel. Have you ever wondered if the stock market is fair? Have you ever felt like the game is rigged in favor of the big players, hedge funds, banks, and insiders, while the average investor is left struggling? If so, you're not alone. Millions of retail investors suspect that the stock market isn't an even playing field. But is that suspicion based on reality, or is it just paranoia? Today, we're diving deep into the truth about market manipulation, the influence of high-frequency trading, and the real tactics that Wall Street uses to gain an edge. By the end of this video, you'll understand exactly how the market works, who controls it, and, most importantly, how you can protect yourself and still come out on top. Let's get started. Who really controls the stock market? To understand whether the stock market is rigged, we need to ask a crucial question. Who actually controls the market? Most people believe that prices are driven purely by supply and demand, meaning that if a company performs well, its stock price should naturally rise. But in reality, that's not always how it works. Large institutional investors, including hedge funds, mutual funds, and pension funds, control the vast majority of trading volume. According to research, about 80 to 90% of stock market transactions are executed by these massive financial institutions. That means they hold significant power over price movements, especially when they trade in large volumes. Even worse, many of these firms use sophisticated algorithms and insider knowledge to maximize their profits, sometimes at the expense of retail investors like you. But how exactly do they do this? Market manipulation. How big players tilt the odds in their favor. Market manipulation isn't just a theory. It's a reality that has been exposed time and time again. Some of the most common forms of market manipulation include pump and dump schemes. A group of traders artificially inflates the price of a stock by creating hype, only to sell their shares at a high price and leave retail investors holding the bag. Spoofing. Large firms place fake buy or sell orders to trick the market into moving in a certain direction. The moment the price shifts, they cancel their orders and profit from the change. Dark pools. These are private trading exchanges where big institutions make trades away from public eyes. This allows them to manipulate stock prices without triggering alarms. Short ladder attacks. A coordinated effort to drive a stock's price down by selling shares back and forth at decreasing prices, making it look like there's panic selling when there really isn't. These tactics aren't just theoretical. Let's take a look at real-world examples where manipulation was exposed. Real-life cases of market manipulation. One of the most infamous cases of market manipulation involved Goldman Sachs and the 2008 financial crisis. The bank was caught misleading investors by selling them mortgage-backed securities while simultaneously betting against them. This contributed to the market collapse, yet very few executives faced real consequences. Another more recent example is the GameStop GME short squeeze in 2021. Hedge funds heavily shorted the stock, betting that it would fail. However, retail investors on Reddit's Wall Street Bets banded together to buy shares, forcing the stock price to skyrocket. This caused billions in losses for hedge funds. But what happened next was shocking. Trading platforms like Robinhood suddenly restricted purchases of GME stock, making it impossible for retail investors to continue buying. This led many to believe that the stock market was indeed rigged against small investors in favor of Wall Street elites. High-frequency trading, the unfair advantage of algorithms. One of the biggest reasons retail investors struggle to compete in the stock market is because of high-frequency trading, HFT. HFT firms use powerful computers to execute thousands of trades per second, taking advantage of small price movements that are invisible to the average trader. These firms co-locate their servers next to stock exchange data centers, allowing them to execute trades milliseconds before everyone else. This gives them an unfair advantage, allowing them to profit off price changes before regular investors even see them. A famous example of this was exposed in Michael Lewis' book, Flash Boys, which revealed how HFT firms manipulate prices and front-run retail investors' trades. Essentially, by knowing what trades you're about to place, they can buy or sell stocks ahead of you, forcing you to pay a slightly worse price every time. Over millions of trades, this adds up to billions in profits for them. Why the SEC and regulators can't stop market manipulation? You might be wondering, if market manipulation is so obvious, why don't regulators stop it? The truth is, agencies like the Securities and Exchange Commission, SEC, are often slow to act and underfunded compared to the massive financial firms they're supposed to regulate. In many cases, the SEC only catches manipulation after the damage is done. Even when firms are caught, the penalties are often so small compared to their profits that they see fines as just the cost of doing business. For example, in 2020, JP Morgan was fined $920 million for market manipulation in precious metals trading. While that sounds like a lot, the bank made far more in profits than the fine itself. This sends a clear message. Market manipulation pays off. Can you still make money in a rigged market? With all this corruption, does that mean you should avoid investing in the stock market altogether? Not necessarily. While the market may be tilted in favor of big players, retail investors can still make money by understanding the game and making smart decisions. Here's how. Long-term investing beats market manipulation. While short-term traders are often victims of market manipulation, long-term investors benefit from overall market growth. The stock market has historically risen over time, so buying and holding strong companies is still a solid strategy. Avoid high-frequency trading traps. If you place large market orders, HFT firms can exploit them. Instead, use limit orders to control your purchase price. Follow smart money moves. Keep an eye on institutional investors' trades by reviewing 13F filings, which reveal what major funds are buying. Don't trade on emotion. Many market manipulations rely on fear and greed. If a stock is suddenly crashing for no clear reason, it could be a short ladder attack or another form of manipulation. Final thoughts. Is the market rigged? So, is the stock market truly rigged? The answer is yes and no. Yes, because institutions have access to tools, strategies, and insider advantages that retail investors don't. Market manipulation exists, and high-frequency traders exploit everyday investors. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.